The brokerage firm Sharekhan and Mirae Asset come out with a research report on ICICI Bank. According to the brokerage bank focus on delivering steady growth. Loan growth is likely to outpace system growth despite growth moderation in unsecured retail loans in H2 FY 2025, led by business banking and corporate segments. The bank has taken a few corrective actions in the unsecured loan segment, including increasing pricing, rationalizing sourcing payouts, and tightening credit filters, resulting in growth moderation. The business banking segment continues to witness strong traction even as the overall economic environment has softened, as the bank has revamped its strategy, enhanced resources, and streamlined internal processes. Demand from the corporate sector is here, and loan book is also much more diversified here. The focus is on the mid-corporate segment. The current competitive environment is comfortable to deliver 15 to 16% loan growth in FY 2025 and is expected to be broad-based. NIMs to remain broadly stable until the rate cut cycle starts. NIMs are expected to be broadly stable in H2 FY 2025 versus H1 until the rate cut cycle starts. Of course, the lower interest rate cycle will negatively impact margins as till the 51% of the loan book is linked to the repo, which will get repriced immediately. The rest 17% is linked to MCLR and 32% is fixed rate book. On the positive side, OPEX growth would lag income growth, which would ultimately offset the impact of lower NIMs. Credit cost to normalize gradually. Normalization of credit cost is expected to be gradual until we see a major economic downturn. Additionally, the bank has non-NPA provisions of 1.0% of loans outside the PCR. The asset quality is holding up well, and the overall portfolio is still not showing worrying signs, including unsecured retail loans. Increased delinquencies in the unsecured retail segment is expected to stabilize over the next couple of quarters. Credit cost would be still far lower than the long-term averages, as portfolio risk is still within internal limits despite the increase in delinquencies in unsecured retail. Over-leveraging remains a key concern for the industry, mainly in unsecured lending segments, and the unwinding process is ongoing, which may take a few more quarters and continue to put pressure on the segment's growth in the near term. The customer segment that the bank is focused on is holding up well on income and leverage. Business banking, corporate segment, and other secured retail loans are holding up well. Our call valuation maintained by with a revised price target of 1550. ICICI Bank currently trades at 2.6x, 2.2x, 1.9x. Its FY 2025 EFY, 2026 EFY, 2027 E-Core BV estimates. Overall, we see ICICI Bank as relatively well-positioned in the sector in terms of asset quality growth and profitability. The bank continues to outperform peers on most of the parameters exhibiting strong franchise strength, and thus, the current valuation premium to peers is likely to be sustained. We believe the bank is likely to sustain ROE over tilde 2% in the near to medium term. The bank has been delivering predictable earnings with healthy growth on a sustained basis, which is a key positive. Key risks: lower loan growth and higher than anticipated credit costs, slower growth in retail deposits, and lower than expected margins.